With Steve Englander on the show with us. Steve, hi, good morning. Good to have you on the show. How is it that you're assessing this little bit of a shake-off that we had overnight? And I say little bit only in the context of how much world markets have gained so far this year.
Yeah, I'll tell you, there was a lot of puzzlement in the New York morning when equity started coming off and bond yields started coming off. The ISM manufacturing wasn't that weak. It wasn't anywhere in recession territory. Um, I think there was a loss of confidence. It may have started in the Asia session before New York came in. Um, there may have been a few other reasons, things that people were looking at. I think oil is a symptom, not a cause of what we're seeing. Once again, the market may be a little bit too pessimistic on where the US economy is going. And not that it's going great, but that, what it's pricing seems to be a full-blown recession, that the Fed won't have enough uh, won't have enough time to avert with rate cuts. And, right now the pace of slowdown is such that I think that they will have enough time, that it won't mean that the going will be good, but it's not going to be the classic 2-quarter negative recession that we sort of study in school and that we look back to in history.
Steve, can I say that, look, markets had reached what could be called as an Humpty Dumpty level. They were due for a correction, and the correction has come in. We may find reasons to attribute to the sell-off in crude or the sell-off in equities. The bottom line here is that this was an overdue correction, and it has simply happened, and we must endorse it.
Well, look, that's quite possible. I'd say sentiment is terrible, and that it certainly doesn't help equity market performance when the leaders are getting crushed as much as they have been today. I think one difference versus a year ago, 2 years ago is the Fed's the market's friend now. It expects inflation to come down. Inflation is very close to being in the area that they would consider to be the target zone. And they've made it clear that they don't think that there's a need for unemployment to go much further. So I think the shift from the Fed kind of saying, look, central bank has to do what a central bank has to do, even if it's painful, to the Fed saying, we don't think the labor market has to ease much more from here. I think it means that they'll be very responsive if it turns out that the economy is as weak as the market fears. So I'm not as pessimistic as market pricing, but you have to have proper humility on these calls.
Morning. I wanted to also get in your take then as to what was taking place in the markets just about a month ago, because there were still of those concerns of the US economy falling into a recession. Are those fears now completely on the back burner? And given the fact that we're seeing data points coming in and the markets seem to be reacting quite adversely to each of these?
I think that last month's unemployment rate rise was the key factor, that the market thought that the US was falling into recession and falling into a normal steep downturn. Subsequent data were better and didn't support the recession thesis. As I said, I don't think manufacturing was that terrible. It wasn't great, but we've been here before multiple times without being in recession. But it's almost as if the market wants to put pressure on the Fed to at least think about a 50. And so it's trading in a very pessimistic sort of way. We're not that pessimistic on payrolls. We think it's going to be 170. We don't think the unemployment rate will continue to go up. We think it will be flattish. We're still at 25, and I think the Fed would prefer to be at 25, but I think the market would love it if the Fed would do 50 at this stage.
Right, gonna let you go on that note. Steve, good to have you on board, getting a sense as to what are some of the important data points that we're tracking across the globe and which way the Fed as well could move.